Okay, we are back with the one and only Lyn Alden, who I know does not like compliments, but I want to compliment her right off the start. Lyn, you bring such a wildly informative perspective to the entire macroeconomic world for people. And I think you distill it down to a point where people can really take the information that you share and have it make sense for their local situation in whatever country they are in or whatever city they're in. So you just do a fantastic job at that. So thank you. Just in case I forget to thank you later, I want to thank you now. Thank you for doing everything that you do.
I do my best to be helpful, and I appreciate that.
Yeah, no problem. And I did mention that I think you have a little more spice in your tweets lately. I don't know what's going on with Lyn, but you seem to be, I don't know, maybe you always had this in you, but I just see you out there, maybe on Nostr a bit more, maybe on Twitter, I don't know, there's a little bit. Would that be accurate? Is there a little bit more spice or something in your tweet?
Maybe a little bit. I think it comes and goes, and I think when you do something for a bunch of years, it's nice to kind of switch things up a little bit, or
sure,
you know.
Yes. Yeah. I mean, you have the track record and confidence maybe to just say it like you feel it. But Lyn, for those people who are hearing you for the first time, could I just ask you for a brief, I don't know, 1 minute or whatever you'd like, just to introduce yourself so it gives someone context for someone listening for the first time?
Sure. So my background is electrical engineering. So I spent 12 years working in engineering, and then shifted into engineering management and overseeing the finances of basically an engineering department. It was specifically an aircraft simulation facility, so multidiscipline. But I've had a lifelong interest in investing. And so I eventually left that to kind of the way I view it is like apply systems engineering thinking to macro. Because it's basically the thesis that these big monetary structures, the way things are run, they are effectively systems. They're human-built systems, and much how I would, analyze a control system with inputs and outputs and governing logic. I apply a similar thing to what we see in finance. So I provide research, and also I'm a general partner at Ego Debt Capital.
Yeah, that's right. And for anyone listening, Lyn's free email that goes out, I don't know how often you publish, it seems regularly. You have a paid for version that we subscribe to, but the free version alone is just worth its weight in gold. So if you like this information, definitely want to track that down. And at the end, I'll ask you for the URL and that stuff, Lyn. Okay, so I want to start off, and I prepared you a little bit for this by just saying I'm going to pepper you with a few slides. But we haven't done this before, but I wanted to show you something that Luke Gromen shared in one of his newsletters. So I want to give him credit for putting these illustrations together. I'm just really interested in your thoughts on this, because I think here in Canada, and I assume in the US as well, there is a lot of confusion on what's going on with the administration right now. What is going on with tariffs? Why are tariffs being discussed the way they are? And to me, it all comes down to an evolution of Triffin's dilemma that perhaps started, and we are coming to this natural climax of it. And I think that's what's being tried to address here. But I like Luke's illustrations, and I just wanted to get your thoughts on them. So I'm going to just add them to the screen here. And the first one is how Luke Gromen I think, did a really nice job here in explaining the flow of money in the world, kind of post 1971, from 1971 on. And for anyone listening to this, I just want to read it out just so everyone can kind of follow along in case you're not looking at the screen here. But basically what he's saying is that, around 1971, U.S. basically had no tariffs. It offshores manufacturing base and jobs to the rest of the world. The world will send goods to the U.S. consumers. The U.S. then sends U.S. dollars to the world for the goods that the world is producing. The world takes those U.S. dollars that it gets and buys U.S. treasuries, invests in U.S. capital markets. The U.S. collects income tax from U.S. citizens to finance U.S. deficits. That's kind of like a quick summary, and I'm sure we can pick that apart a little bit, but a quick summary of just the flow of funds around the world and kind of how trade has been going. And there are some issues with that will just, have been discussed over the last few years. And now we're coming to this climax, and the Trump administration has come in, the new Secretary of the Treasury, Bessent, has come in and said a few things. And I think Luke does a pretty good job of breaking this down here. And this is what I wanted your thoughts on. He was kind of suggesting that what he's thinking is that this is now the strategy that may be trying to introduce into the US, which is the US increases tariffs and reduces US income tax, which have both been spoken about. The world then sends US dollars to pay for tariffs into the US as US demand increases. The US sends US dollars to the world for the goods that are currently being produced outside of the US. The world invests those US dollars now, not in treasuries, but in US factories to address the booming US demand in the US. The US then produces swap lines to and has the Fed to do some sort of QE to finance the treasuries that may have now lacked a buyer because the foreigners are now not buying treasuries and maybe they're buying, investing in factories in the US. The world buys gold or Bitcoin instead of US treasuries with any net surpluses. The winners of this are global capital, Washington, D.C., USA, and US citizens would be winners of this. And the world gets richer over time. Too big to fail banks and long-term U.S. Treasury holders get poorer over time via financial repression. The U.S. industrial base gets rebuilt. So I realize I just threw a lot of information out there, but I really think this kind of gives me context of maybe this is kind of what's happening. And I'm super curious to your thoughts on this, Lyn. When you see that, what comes to mind?
Yeah, I think it's a good set of charts, and Luke always does great work like this, especially on this topic. One of the ways we can kind of summarize a lot of this is to basically say that this is kind of the outcome of having the dollar be monetized, to be treated as like global money, whereas other monies don't really have that same usage. So most currencies trade when they have like various fluctuations against each other, they mostly trade on things like what's their trade balance doing. So they generally, if they run trade deficits for a while, often it will correct against them, usually not pleasantly, but that'll kind of fix that structural imbalance, as well as interest rate differentials. And that's kind of how the majority of currencies function. And what's interesting about the dollar is that because the dollar is held by most countries around the world, often in the form of U.S. treasuries, but also like literally deposits in U.S. banks, deposits with the Fed, as well as U.S. capital markets, it basically means that in addition to those normal things, the dollar also has an extra monetary premium on top of it. And so it kind of makes the dollar overvalued on a trade balance basis. And it's also used as the global financing currency. So it'll often be the case that, say, a firm in France helps finance an entity in Brazil. It'll be with dollars instead of either of their currencies, just because it's the leading network effect. It's the ledger that multiple different entities can use. And the offset of that is that basically everybody in the world needs dollars because they have dollar liabilities. They invoice things in dollars. And the way that they get dollars is they basically overvalue the dollar. And therefore, American import power gets very strong. We send dollars out into the world, and our export power is weak, especially for lower margin things like manufacturing. We're still good at tech and healthcare and finance, but not so much manufacturing compared to many other peers. And this over time, it sounds like a good thing at first. We're sending dollars and we're getting goods in return. But the other way to point out, and he has that full kind of capital cycle, is that when we send the dollars out there, foreign entities come back and reinvest it into our capital market. So what we're actually sending out is ownership in our companies and our property compared to the rest of the world. And we're basically buying depreciating goods by sending them parts of our appreciating assets. And it also has an imbalancing effect because if you work in the Rust Belt, the reason it became the Rust Belt is because we deindustrialized. Whereas if you work in capital markets or if you just happen to have a lot of assets, you've generally benefited from this arrangement. You can travel the world because the dollar is so strong. Your assets, the whole world's investing in the same assets you are. So they're generally up and to the right. And over decades, you start to get rising populism, rising discontent with that approach. And so I do think it makes sense that they are trying to basically reverse course out of it. And the only part that I might push back on in those charts is that the administration has a little bit of a two-sided aspect here, which is they have all these kind of detailed views of what they want to do for trade realignment, but they say that they want to keep the dollar as a global reserve currency. So, for example, if they saw that chart that says, okay, instead of the foreign sector investing in treasuries, they're going to invest in gold or Bitcoin or whatever, there are elements in the administration that would say that that's not necessarily our goal. whereas there'd be other elements in the administration that say that is our goal. And I think that's probably one of the challenges they have to navigate.
Because the challenge there being, we don't want to lose. We need the dollar to weaken, but we don't want the dollar system to kind of fall apart either. Like, is that that's kind of ultimately the challenge, right? Like, hey, listen, we are all for the dollar weakening here, but we need the dollar system to keep going. Correct?
Yeah, essentially, there's a trade-off by being the global reserve currency issuer. Is basically you get a huge sanction power, and the government it has much easier time finding itself. So, for example, Brazil has similar deficits on a percentage basis than the U.S., but that gives them a currency problem because there's not this like structural demand for their currency, whereas the U.S. Government can kind of get away with a longer runway there. And then the other side is that industrial base issue. And so, generally speaking, they try to maximize both, but it's often hard to do so. And if you look at parts of the administration, like they propose things like taxes on reinvesting capital in the U.S. So like if a foreign entity wants to hold treasuries, they might actually talk about discouraging that at above a certain scale by basically putting taxes on some of those assets and say, okay, you can hold treasuries, but we're going to take back some of those basis points and make that a little bit less attractive for you to do, to maybe discourage you from doing it. But then there are other parts of the administration that are saying, hey, we like stable coins because it'll get treasuries out into the world more and increase demand for treasuries. And those things have some degree of conflict with each other.
Okay, got it. So then I guess in the first step of my next kind of questions around this for you would be, you do think this is something that the administration is trying to do? Onshore manufacturing, bring jobs back. Like this is an active, real thing. They're not just talking this. This is something real. Correct?
Yes, I believe so.
Okay. And then on the stablecoins comment that you made, I never know what to make of that. That just seems so like naturally the right way to go, but also such an extreme way, I would think, for any US administration to actually go. Like to say, okay, yes, let's encourage stablecoin usage around the world. That stablecoin usage then increases demand for U.S. treasuries because as people in Brazil or Argentina try to get U.S. Stablecoins, the funds are then going to be taken by these stablecoin companies, and U.S. treasuries will be purchased. So we've created this like net new demand for U.S. treasuries. It's brilliant. The probability of the administration coming out and actually pushing this, is this what percentage do you give that over the next 4 years? Like, this is something real, you think?
Well, I think stablecoins already are proliferating pretty significantly. I do expect that to be up and to the right over the next 5 years or so, which through this administration and into whatever happens next. And I think the issue there is if you look at those two charts you showed, the first one is the U.S. Is the rest of the world reinvesting in treasuries and capital assets, whereas the second one is basically having them invest in manufacturing facilities and put surplus into gold or Bitcoin and other kind of neutral assets. Whereas actually what the stable coins do is they keep the first chart in place. They keep a portion of the world reinvesting in treasuries to the extent that they're successful, and that's where there's a little bit of a conflict potentially.
Got it. So what do you how do you think this plays out then? What are you thinking?
My expectation is that this is probably going to be a very long process, much how the deindustrialization. I think the deindustrialization took decades to occur and reach a scale that became like politically among the biggest things, that to the point where an administration would start highly prioritizing it. And I think this is an initial set of first steps to say, okay, we're at least talking about the problem, doing steps to address the problem. And I think that there probably will be fits and starts along the way, and it'll take, decades to gradually unwind that and kind of reindustrialize.
Yeah, got it. Okay. Here, I'm going to, let me share another slide with you now. Let me put this back up. I want to go to this next one. So in Canada, definitely, I guess it's split depending on who you speak to. But when Trump came out and the U.S. administration came out and said, "Hey, Canada, let's just merge together," or whatever they're saying, Canada will become the U.S. or whatever it is. The first ask on any sort of negotiation. Sometimes I find myself explaining to some Canadians that the reason Canada is rather interesting right now is that over the last 50 years really has been a financialization of the economy, and to me, it seems like we're moving back to real factories, real goods, real things having more importance and more value in the economy again. And Canada happens to be a country, as this illustration shows up here, that is just full of real things: fresh water, minerals, tons of energy, the ability to produce a lot of hydroelectric power, like all these things that Canada has. So if I was, looking at it, I could see why Canada would be an interesting ask from the US administration. I'm not condoning it or anything right now, but I'm saying I can see the logic. Like, I get it. Is that, when you hear that from me, is that how you see this chatter about Canada right now coming from the US, or how are you looking at it?
I do. I mean, it's the second largest country by landmass, and much like the first biggest, Russia, the thing that both they have in common is tremendous amounts of natural resources of multiple different types. And so I can see why strategically that's being discussed. I think they don't really talk about the other elephant in the room that also permanently would change like U.S. political balance, like the whole electoral college, for example, and ironically potentially shift elections in the other direction. But I get why they're talking about those more strategic initiatives. Say it's not just about financialization anymore; it's about real things. And so I think that's natural that that's being discussed more. And Canada's had a somewhat similar issue with the U.S. in the sense that in the U.S.'s case, the rest of the world kind of monetizes our stock market and our treasuries, whereas in Canada's case, the rest of the world to some extent has monetized their real estate. So especially Asian buyers, for example, have driven up some of the real estate value. Yes. And that's we've also seen that in Australia. We've seen that in parts of Europe and elsewhere. And so it generally a rebalanced economy would say, okay, instead of going and buying up, condos and leaving them empty and just kind of jacking the prices up, maybe go and invest in a nickel mine, or maybe go invest in this other facility. And I think that's longer run, more constructive.
Mm-hmm. Yeah, Canada just historically does such a poor job of productively doing anything with its natural resources. To me, it's just such a shame looking at this country right now. But okay, so when you say that about Canada and the U.S., do you think this is just like a negotiation? Could we be, longer term? Is it an economic union of some sort that you see between Canada and the U.S. that comes to pass? How do you think this ends? Or like, the banging on the table right now from the U.S. about Canada, is it? Yeah, I guess I'm just curious. Where do you think this ends?
That's hard to judge politically. I think right now we're still in kind of the shock and awe phase of the administration. It kind of is like the time of negotiations and things like that. I think a longer term trend is that as the world shifts from being unipolar to multipolar, right? So ever since World War II, the world's basically been unipolar. Especially after the fall of the Soviet Union, where the U.S. is basically this giant pole of power. But as we've seen the rise of China, and as we've seen in general just the BRICS and other developing countries that have a lot of population and a lot of GDP kind of reassert themselves on the global stage, the world is now increasingly multipolar. And so in U.S. politics, it's increasingly kind of like, say, skeptical of aspects of Europe, kind of treating that almost like a different economic bloc. Whereas if anything, focusing more at home and saying, well, Canada, Mexico, we have this whole, continent that's around us, and that there's a lot of strategic alignment there. And so I think that's, if I envision the world in the future, it probably becomes a little bit more regionalized.
Real estate investing isn't always easy, but it can be relatively simple. And that's where the Rockstar Inner Circle comes in. Look, there's a lot of real estate investing information out there these days. That's why it's so important to pick your sources wisely. And even though investing isn't always going to be the easiest process, it does not have to be super complicated. That's where tried, tested, and proven strategies like the ones that Rockstar members use come into play. Everything shared in the Inner Circle is built from firsthand, on the streets experience in the current current market. It's all up to date, things that people are actually implementing today. In fact, the ongoing courses are delivered live, so they're always up to date with the absolute latest real life experiences. As a Rockstar member, get ongoing access to over 20 different systems and programs covering things like which properties investors like and why, our private rental system, what opportunities the investors are scooping up in student housing currently, the legal side of investing, why or how to use corporations as an investor, a mortgage class with the absolute latest options and programs to build your portfolio as an investor because they're different than a regular home buyer. And there's a whole ton more in all those different classes. Of course, to implement all these strategies, members get access to unlimited private one-on-one coaching with an actual human experienced investor, not an AI chatbot, not ChatGPT or anything like that. It goes beyond training, classes, and real estate. It's a community for people looking to take control of their own finances, to give themselves options and allow them to live life on their terms. With ongoing live and virtual opportunities to connect, it's built for investors by investors. You can see everything members get at rockstarinnercircle.com/member. It's rockstarinnercircle.com/member. Now back to the show.
Okay. So the next thing then I want to throw at you here was this, and we mentioned briefly, this kind of comes from a lot of Jeff Booth's thinking, and I know you will talk about a lot of this as well. But whenever I look at this around GDP, it just kind of clarifies where I think I should be personally investing and how I should allocate my own investments. And just for anyone listening, I want to talk through this just a little bit and then get Lyn's thoughts. So the idea here is that GDP is a measure of like of consumer spending, government spending, net imports, and like government investments. So to me, I could summarize it, and this might be a bit too blunt, but just it measures spending. And then some of the influential factors that will kind of like, have direct influence over the GDP number are things like labor or population growth, the first, productivity growth, and capital or debt growth. And when I break these out for myself, it's kind of pretty obvious to see in the Western world. In the US, you can see labor force participation rate is coming down. So to me, it doesn't really look like that's a positive on GDP. Productivity growth, I think in the past, and Lyn, I'm interested in your thoughts on this. Productivity growth in the past during maybe the baby boomers when they were younger, if you could produce more efficiently, you could produce, let's say, more washing machines. And the population is also, at the point where a lot of people are buying these washing machines. Well, then the productivity growth is like really valuable to GDP because you're producing more washing machines. You might even get more jobs from that production, and the population is buying all these washing machines. Whereas now it feels like productivity growth is coming from things like AI. And the AI is actually a net negative. So we might be increasing productivity, but the AI isn't resulting in new things that are being purchased because the population growth is down, and you're actually kind of replacing some workers possibly here. So productivity is actually a drag on GDP. I'm not saying that definitively, and I'm just interested in your thoughts on that, which ultimately leaves the third thing is debt growth. And then when I look at this, I'm like, oh, wow, like if population is a negative, productivity is a new negative or has been a negative, but maybe more hidden over the last 40 years, it's now becoming more obvious that it's a net negative on a GDP measurement, then obviously the move for governments would be just to increase debt, which means more M2, more monetary debasement. Therefore, holding something like Bitcoin to me makes a lot of sense and is maybe the purest, easiest way to play this over the next, 5, 10, 15 years. And I keep staring at this thing. I'm like, I don't know where I'm going wrong here. It just looks like debt or M2 must keep increasing. So now having heard all that, Lyn, what's your take on what I just shared there?
I agree with it. And the way I would probably phrase it is that because we exist in a debt-based system, it's very hard to slow or stop that from accumulating. Because if you look at how much debt exists relative to, say, the monetary base, that ratio is very high. And so it's like a game of musical chairs that can't stop. If you have a game of musical chairs and there's like 10 kids going around like 2 chairs, if you stop the music, it's chaos, whereas it works when it's going. In a recent conversation, the way I described this was in environments where money supply grows faster than resources, then there's an incentive to purposely take out debt and buy resources with it, because you're basically shorting the thing that's increasing in supply and you're using it to go long things that are increasing in supply less. And that creates a more structurally debt-based system. With an example being, there are companies like Coca-Cola or Procter & Gamble that have been around for, like a century, and they've been profitable like every year in my lifetime. And you look at their balance sheets and they have like $40 billion in debt. And then you say, well, why do those big successful corporations have so much debt? And it's because it's a choice. They can issue, in the past, at least they could issue 2% yielding bonds for 10, 20 years, and then use that to, basically increase their capital efficiency. Now, in an environment where money is more sound, and you have something like, like gold has like 1.5% estimated annual supply growth on average, then it doesn't make sense to say borrow gold and buy houses, or borrow gold and buy most other things with that. There's still usage for leverage. There's still usages for kind of near-term debt financing, but having that kind of permanent rolling stock of debt makes less sense. And the way that we've kind of structured this is that for decades we've had the former situation where in most countries around the world, or basically all countries in the world, currency supply and monetary aggregates go up at a faster rate than resources, and therefore we've built up a lot of debt in the system. And then if that ever starts, whenever the music starts to slow, policymakers find themselves in a big quandary because there's so much leverage built up in the system, so they go right back to debt-fueled growth again. And the challenge there is that when consumers are looking at the prospect for inflation, they're trying to get something to offset that. Whereas as you've seen from that chart, like inflation is not measured from zero. Inflation is not like the baseline for inflation is not zero. Usually the world gets more productive each year, as long as it's not in like a major war or something. Usually we're finding ways to increase our technology, get more productive, which means we should, by that logic, have deflation.
A negative, yeah.
And the way that things work is that the more disinflation or deflation pressures we have from productivity growth and other things, policymakers are still saying, well, we don't want total monetary aggregates to go down, because then we have all these existing liabilities in a musical chair situation. So they say, well, we want to have 2% inflation. So they can say, well, if productivity is negative 4% a year, we can issue things at 6% and still be at positive 2. And that's, I think, the trap that policymakers have found themselves in this kind
which is interesting to me. Yeah, and what seems so interesting to me about this is that the productivity seems to be increasing, so that like before, if productivity growth was like, a negative 2% on the GDP number, or was kind of deflationary at 2%, I feel like now we're entering a world where maybe it's not going to be 2%, like maybe it's 4, maybe it's 6, maybe it's 8. And to offset that, the amount of debt growth that needs to happen, or new monetary creation, M2 money supply that needs to happen to offset that, we're suddenly entering a world where it's a new ballgame, because the productivity growth is now exponentially increasing, it feels to me. Do you think that's off? Like, am I exaggerating that point a little bit?
I think that's true. And the caveat that I might add is that we could see two different directions of productivity in the same time. And so if the world does become more regionalized, so backing up for a second, globalization was also a disinflationary pressure. They basically said, okay, so Soviet Union broke apart and opened up to the world. China opened up to the world. And the West said, okay, we're going to combine our capital with your resources and labor, and we're going to reorganize global supply chains in a way that's hyper efficient. The downside of that is,
got it.
Yeah, the downside of that is it's fragile. It's fragile, and it hollows out the parts where the industrialization used to exist. And so that was like a 30+ year structural disinflation on real goods, and that possibly could slow down a little bit if we start reshoring supply chains and regionalizing things. But then to your point, I think that we could still have even more accelerating disinflationary pressures from AI and software as a whole.
Yeah, got it. Okay, yeah, that's well put. I never really thought of a market like China opening up, and that's like a deflationary force. You're opening up a labor market that is much cheaper. It's a deflationary force on the economy. Yeah, got it. So it all comes down to the rate of this productivity increase. Wow. Okay, like wild times ahead. Okay, and then. Yeah, I'll save the next question. I was going to ask you another question about Bitcoin. I'm going to save that for a minute. I want to show you the next chart now. The next chart I have for you is this debt to GDP in the US. I think it like topped out at like 130 during the pandemic, 130% of debt to GDP. It's now sitting at like, I think it's 120 or so right now. And on the next slide here, I just have, interest payments. I just like looking at this chart, Lyn. I wanted to put it in there because it's just so ridiculous. I just put this
cartoonish.
It's just totally cartoonish. But when you see this, and I guess the question is really about debt to GDP, where is debt to GDP, if you had to guess, going to be in 5 years' time? Like, where do you think this number sits 5 years from now, if you had to guess? And what are the sequence of events to get it to where you think it's going to be?
It's a good question. I think the first part I would back up and say, how did it get here? And in general, what we've seen is that we've had 45 years of rising debt to GDP, but falling interest rates. And therefore, the debt financing costs have been relatively contained. Like, for example, if you look at that interest rate chart, interest expense was rising. Yeah, so that, the other one. So if you look at the 70s and 80s, that was up and to the right very sharply. And if you look at the peak zeitgeist, where people actually cared about the public debt, that was the peak. So in the late 80s, the national debt clock went up, the famous national debt clock in New York. And in the US, Ross Perot ran what was basically the most successful independent presidential
I remember,
campaign.
yeah.
And it was largely built on debt and deficit and stuff. So that was like the peak, that the late 80s, early 90s was kind of the peak zeitgeist. But then, as we just talked about, that's when we really started to get like Soviet Union and China opening up to the rest of the world. So we had this kind of period of unexpected disinflation of physical goods. And then to actually see the interest expense really slow down for quite a while, because we had rapid declines in interest rates. And so even as debt to GDP rose, interest expense was contained. And what happened more recently is that interest rates basically bounced off zero. And we had very big fiscal responses, in response to the lockdowns and stuff. And so the outcome of all that, we still have the rising debt to GDP, but without the offset of structurally falling interest rates. If they just trend sideways now, they're no longer an offset, let alone if they go structurally up. So that's a kind of the preamble. I think to answer your question, I would say that I would expect debt to GDP to be moderately higher in the future. Like say 5-10 years, I think we'll probably revisit the 130% figure. That was kind of temporarily an artificial figure, because that was partially because GDP just like collapsed for a couple quarters during the lockdowns and stuff. So that's kind of like one of those temporary like false numbers. So you can kind of like factor that out. But I think we're still kind of gradually up and to the right. The part that I think might surprise to the upside is nominal GDP growth, because what we see in some of these periods of high deficits is going back to that prior equation of that GDP equation. When governments are running these massive deficits, that is generally inflationary, and it boosts nominal GDP. And so I think that the total U.S. aggregate debt is going to continue going up rapidly, and I think that there will be nominal GDP growth, even though that's not always the right measure to be looking at. And so I think we'll revisit 130.
Okay. And then I'm just thinking for like the average person listening to this out there. So when you're saying nominal GDP, so that is going to be reflected to them as inflation. So higher prices for everyday goods in everyday life, correct? Is that a fair assumption?
Yeah, and then even when looking at real GDP, it comes down to how accurately that's measured. An example I like to use is that if you look over the past 10 years, Egypt's real GDP per capita has ostensibly gone up and to the right. But when you look at their energy usage per capita, it has been flat to down over that time. And if you survey people and say, how many hours of labor does it take to buy a car today compared to how many hours of labor it took 3 to 5 years ago, it's not generally moving in the right direction. And so it really kind of bears questioning if GDP is always the right measure of economic activity. It's kind of one attempt to capture it. I
think it's a horrible you're so well spoken on this subject, and I think kind of fair. I'm just more like, I don't know, it feels like a bullshit measure to me. It just seems like we're measuring spending. Like it doesn't measure the health of any organization. Like we're business owners, doesn't measure the health of the balance sheet of the business. It doesn't measure the kind of the quality of life that citizens are living in a country. It just seems like an awful, honestly, it just seems like a horrible measurement to me that we're basing all our economic decisions off this. And I see you shaking your head. So you're sorry, nodding like you're agreeing.
Yeah.
So we can kind of move on. It just seems kind of rather silly that we're like, I don't understand why we don't measure. I've joked around saying we should measure people's purchasing power. Like, why don't we just measure people's purchasing power? And if, for $1,000, somebody can pay more rent and more groceries out of that $1,000 every 6 months or every year, then we're kind of like winning, but we don't measure that. Anyway, we don't have
agree. And one way to kind of capture that is basically hours of labor to buy, a basket. And there's still imperfections. People can argue about what the basket is. How do you define the basket? Kind of like CPI. But I do think that would be a better metric than GDP itself.
Yeah, seems so ridiculous. I seem to get all worked up about it. I really love how you stay so even keel about this, Lyn. You have a talent with that. But then I'll see your memes on like nothing stops this train. So I know it's in you. I know it's in you that you say like it's just all of this is kind of nonsense. I have this for you, just more for information. This is just to show you Canada's M2 money supply, very similar to the US. From I always measure it from when I was born in 1973 for whatever reason. That's like my yardstick, and it's 8.77 is the compound annual growth rate from 1973 to present day. So no real point on that. And I just wanted to show you this because we're in the middle of an election season here in Canada. It's small, so you can't make it out, and I can't source it, but I don't know who shared this to give them full credit. I think their Twitter handle's down there. I should have made that bigger to give them full credit of sharing this. But this is just, I haven't verified the data on this, but it is making the rounds up here because it is election season in Canada. And Canada's real GDP per capita on this chart is like right at the bottom of it. Looks like, I don't know, maybe 30 countries or whatever this list is here. And I think this does sum up the state of Canada over the last 10 years. So Lyn, I don't know how much attention you do pay to Canada, but it has been a horrible decade up here for GDP growth. And like, you can feel it. You can just feel it in the angst in the population. Like there is not much savings happening. People do not feel like they're getting ahead. The population feels this strongly. So, it'll be interesting to see this election in the next few weeks is going to be interesting. But here's what I wanted your take on. So I think this is fairly accurate that there's $8 or $9 trillion worth of U.S. debt that needs to be refinanced this calendar year. So when you see that, where do you think, is there anything that you think the administration, the Secretary of the Treasury is kind of working on? Like, what can we anticipate over the next few months to see in either rates on the short term or 10-year rates? Because this seems to need to be dealt with, and I feel like rates need to come down to deal with it. What's your take on this?
So I think the vast majority of that refinancing will be bought by the similar entities that already hold it. That's how most of this works. And so, for example, money markets that hold T-bills, as those T-bills come due, they mature and then they reinvest them in new T-bills. And so because a big portion of U.S. debt is 2 years or less, we do tend to have a pretty front-loaded reinvestment cycle. But yeah, a bunch of banks, a bunch of big funds, a bunch of insurance companies, these big pools of capital that hold this. The gross numbers, the majority of it will just be refinancing that. And then so the remaining question is, well, what happens on the margin? Is the marginal buyer in their favor or not? And so I see that metric, and I think sometimes it's overused because they see the gross number, and that's obviously a pretty horrifying figure. But it's the net number that we probably care about more, which is sub 10% of that figure. So I do think that they're going to have issues there, and I think that's also why when you look at the Fed's plan, they're slowing down quantitative tightening, especially on the Treasury side. So they're continuing to let mortgage-backed securities roll off their balance sheet, but they're gearing up toward basically being flat on Treasuries. And then possibly later this year or 2026, depending on how kind of slow they go they could eventually get back to actually gradually increasing their Treasury holdings while they're also gradually diminishing their mortgage-backed securities. And that's they won't phrase it like this, but that is essentially financing U.S. deficits and debts.
What I know you've written about this recently. I just wanted your take. What are you making on the current level of the gold price right now? Like, what is gold telling you at $3,000 an ounce or so? What is it telling you right now?
So I think, it reflects a lot of the debasement that happened over the past 5+ years. It can take a while to trickle out. When everything was booming people were more interested in to put it in stocks than in gold. But as things eventually kind of slowed down, some of that capital, I think, spilled over more into gold. In addition, there's been a really strong central bank bid for gold over the past several years, even though the rest of the world, on average, does hold more treasuries nominally than they did 5 or 10 years ago. It's a really slow growing figure. And especially when you look at official holdings, like central bank holdings, it's basically flat to down on treasury holdings over like a pretty sizable timeline, like 10 years. That was really kickstarted by China when they said something,
Forget it. Yeah.
Like 11, 12 years ago, they were like, it's no longer an interest to rapidly accumulate treasuries. We're going to instead recycle this into Belt and Road Initiative stuff. So that was kind of a catalyst for this. But we have seen central banks continue to accumulate gold. And so there's been that shift around the margins that has been constructive for gold's price. In addition, there's always strong kind of consumer demand out of China and India. And so I think I think the gold price is in a good place. It's always a little concerning when you see something go up like 40% year over year. But I do think that the asset itself, when you look at, say, the 5-year performance, I think it makes a lot of sense.
What do you make of? Sorry, I'm going a little rapid fire now on you. What do you make of the Bitcoin Strategic Reserve announcement? What does that mean to you? Anything? Is it like a sign of something to come? What are you making of that?
So far it's in line with my base case, which was that they probably would have ring-fenced their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that, and that's what the executive order said to do. Basically, take those coins and put it into a separate reserve and don't sell them. I think the slight upside of the executive order to do it was that the Treasury's authorized to explore budget-neutral ways to accumulate Bitcoin a little bit more. I expect that to be kind of low numbers, but maybe I'll be surprised to the upside. And then they also, I think, did a good job of separating out Bitcoin from the rest of the cryptocurrency space, because they put those, again, from like forfeitures and forfeitures and seizures, they put them into a different bucket and is treated differently, because the Bitcoin one, by executive order, they're not allowed to sell it. Whereas by the same executive order, the Treasury Secretary can use their judgment to figure out what they want to do with other coins, which can include selling them. And I think that's good, because generally speaking, you don't want a government picking favorites on assets that are kind of securities or have security-like aspects, like as they're entities with an issuer in many cases. And so rather than choosing different cryptocurrencies, many of which have a long track record of underperforming Bitcoin over multiple cycles, it's kind of just treating that as a separate, less important pool of capital, and instead kind of focusing on Bitcoin. But I think that the majority of the outcome is just going to be no longer them selling it, and we'll see what happens around the margins for further accumulation. I wouldn't bet my long-term bullish thesis on the idea that America is going to go out and buy like 500,000 coins. It would shock the price of the upside if they did. But my general bullish case is kind of assuming that it's roughly flat or flat to mildly up over the next several years.
In your newsletters, have you put any Bitcoin price predictions? Or are you staying away from that? I forget if in your latest newsletters you have any price predictions for Bitcoin over the next 6 or 12 months. Are you sharing anything like that right now?
Not particularly. I mean, earlier I said I think.
I know it's a wild question.
Yeah. I try to give conservative targets. And for example, I was pretty sure we would hit 100K, and we did. I thought maybe we would hit it in 2025. It was interesting that we touched it late last year. What I tend to monitor instead is levels of euphoria. So instead of saying, it's going to go to this price by this year, there's a couple of things I look at. One is Bitcoin tends to correlate with liquidity conditions. It generally does better in conditions where liquidity is going up, which is in some ways another way of saying debasement's going up, which is different than just CPI. And then the other one is like when you look at some on-chain characteristics, one of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about.
Sure.
Want to be able to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like to put it in real estate terms, if there's like say 20 houses on a street, and like they haven't, none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price. Generally speaking, the value of that the whole street now is higher, even though only 5% of the houses, 1 out of 20, have basically now moved the price, the perceived price of all those houses. The same thing happens in a more liquid sense in Bitcoin, which is there's a bull market around the margins. It's tightly held. Some influx of capital comes in. Bitcoin goes up really quickly. But when you look at how many coins actually changed hands, it's usually a pretty small percentage in that initial bull run. And then you kind of like want to see that become more real. So for example, on that house street, you'd want to see another house sell at like a similar price, and maybe a third house before you say, okay, this is probably like something approaching the new price of the street. We can have more confidence in it. And the same thing with Bitcoin. When you see more and more coins trade hands at those higher price levels, it helps lower that ratio, because basically the cost basis, the average cost basis, is catching up to some extent with that wild explosion in market cap. And so what I generally point out is that we've not really seen extremes yet this year. Back in March 2024, when we broke out to new all-time highs for the first time in a couple of years, so Bitcoin hit something like 73,000. That metric got a little bit euphoric, but nothing like a multi-year top historically has been. And so we saw like a 7-month consolidation, but nothing really worse than that. And similarly, when Bitcoin hit 100,000 or up to 108,000 more recently, that metric similarly got a little bit overdone. But again, it wasn't one of those multi-year dislocations that we normally see. And so for me, I'm more on the lookout of ranges or probabilities of breaking out versus breaking down. And so my view is that there's still a higher probability of breaking up, and to say that I don't think we're set for a multi-year bear market until we probably reach higher prices.
Mm-hmm. Okay. US dollar is coming down, and risk assets in the US seem like they're coming down. I think you've written about that recently as well. I think you have it in your latest newsletter. I'm not sure, but what do you make of that? US dollar getting weaker, risk assets coming down in price.
Well, so I think it's basically a potentially initial unwind, a very tiny percentage unwind of a very one-sided trade, which is due to dynamics we discussed kind of at the beginning of this talk. A lot of global capital stuffed into U.S. stocks, kind of like how a lot of global capital is stuffed into Canadian real estate and Australian real estate. For us,
I love how you keep bringing that up, because it's so true. Like, you're 100% accurate. Yes.
Yeah. There's certain parts of the world that we monetize, and for the U.S., the kind of the biggest, most liquid market is our stocks, and so the whole world monetizes our liquid assets pretty strongly, and basically that can become self-perpetuating, because that also strengthens the dollar, and then a stronger dollar hurts various emerging markets that have dollar-denominated debt. It kind of squeezes them. Which makes them even less attractive to invest in. So even more global capital is like, you know what, I don't want to touch any of those areas. I just want to be overweight US. And that's a flywheel that's like self-perpetuating until either it reaches such extremes that it exhausts itself. Like every marginal, like portfolio manager is basically, net long or overdone US stocks. And there's really not much more marginal flows that can happen. Or there's a policy shift that starts discouraging that flywheel or disrupting that flywheel, either intentionally or unintentionally. And I think we're basically seeing a combo of both. I think that the move is kind of exhausted, and then we are seeing some policy shifts that add uncertainty and make maybe some of that capital want to repatriate or go home. And I think it's disruptive when it happens, but I think it's healthy ultimately, because I think that it's gotten rather imbalanced.
Got it. Okay, I have two more things for you in your book here, which I think we all love, Broken Money. Last time we spoke, we brought up something really quickly. I just wanted to share with you, because you had me thinking about credit systems and kind of like how money has evolved over the years. And in your book, obviously, you do a wonderful job of explaining how it's broken and broken money and where we are today. And it made me realize something. As a kid, I was dropped off in this village over in a small country called Croatia. And it was probably like 15 families, maybe 200, 250 people. And the way it would work throughout the year is that, like, if you help somebody harvest like a potato field, it was naturally assumed that, like, if one family helped another family harvest that potato field, for example, and I was there, I saw this with my own eyes, that like then that family, like 2 days later, if there was a wheat field to be harvested or something and that family needed help, well, you were going to go help that family. And it was kind of like this form of unspoken credit. Like it wasn't like there was like this little board where it was like, well, we got this many potatoes, so we're going to help you with this much wheat. But it was like, well, you helped us with that, we're going to help you with this. And in between all that, there was some barter happening as well. Like if somebody needed some trade for something, like if you needed a saddle for a horse and you were really good at like either making the saddles or acquiring the saddles in some other way, and another family had something that you needed, maybe they had some like prosciutto or something that you needed for the winter, and you were going to trade the saddle for some prosciutto or whatever it was going to be. Like I saw that with my own eyes happening. It was a mix of barter and credit, unspoken credit, I would call it. And then it just kind of made me think of something like that worked in the village, but I never saw really that credit be extended to other villages that were like maybe only, 5 to 10 kilometers away. Like the credit just kind of stayed in the village. But if somehow that credit was like written down on a piece of paper in that village, but somebody from another village was able to counterfeit it and like say, well, your family actually owes my family 2 harvesting of 2 wheat fields, not just 1. And I have this piece of paper that proves that you owe that to me. Like the whole system would just like break down. Like, in small villages, it's already very gossipy between families. That's just how the nature of that kind of setup is. But like if somebody was doing that to another family, it would immediately just start breaking down. Nobody would trust each other. Everyone would doubt each other. You would help another family less because you didn't trust it. So really, there was a lot of trust in that like unspoken credit. Like you did this for me, I'm going to do this for you. And it happened every year. But if somebody was to cheat the system, like if the credit that was unspoken was put on paper, and somebody was to bastardize that system by inserting new pieces of credit into that system, the whole thing would fall apart. And it would be so obvious in the small village setting. But when we have that at like the global scale, as you've written about, people don't see it. But essentially, that's what's happening. We have all these little pieces of credit that are flying all around. And there's like this body that just is like, oh, like we need some more pieces of credit. We're going to print a bunch for us. And, don't worry about like all that other stuff that it might cause. Like look at our inflation calculators and our CPI. It's like really not that bad. But this is how we're going to like feed ourselves first. And we're going to win first. And like it's all going to work. Don't worry about it. And because it's at scale, you don't see it. And I don't really know why I'm sharing this with you right now, except that your book really made me think about that. I'm like, yeah, at the village level, I saw it happening as a kid, and it worked. Credit did kind of work. But if it was cheated, it would immediately be seen because it was at a small scale. But at today's global scale, you don't see it. And I think that's why I'm personally so passionate about Bitcoin, because it feels like it gives me this honest ledger that I know you speak about, Jeff Booth speaks about, like we all kind of use these words. And it's like, this really has the chance to make the world a better place at a global scale. And that's why I just feel so fortunate that Bitcoin exists and that I want more people to kind of look into it and to read your book, Broken Money, so that you can understand these concepts where then you have a frame of reference to make sense of what Bitcoin might represent to you and your family. So I don't even have a question for you here, Lyn. I just wanted to share that with you.
I think it's a great anecdote, and the way I think we can universalize it is to say that it's not just about geography, like distance. It's about like whether you know the person. So, for example, in the digital age, there are people that are far away, but that I still know to some extent. We've either traveled to conferences together or we interact on social media, and sometimes they'll do me a favor, and then I want to reciprocate and return that favor. And it's still, even though it's long distance, it's still kind of limited by how it's like the Dunbar number, like that conception of like how many like personal connections can we keep in our head at once without having to like write it down and organize it.
Totally.
And that's kind of the village level or the online sub-community level, for example. And so that's kind of our limit. And once we get beyond that, we get into more dishonest ledger types, like historically, and that kind of gradual debasement. One way of kind of putting it is that the issue of the currency gets to change everyone's contracts all the time, and there's all sorts of contracts. Like two businesses will have contracts with each other. A business will have a contract with a customer, and then also everybody who works for a wage, like works for an employer, their employment contract is a contract. And so if they say I'm going to work for $50,000 a year, and the definition of a dollar gradually shifts, it gets debased during that year. It puts a lot of pressure on the employee side to come in and try to renegotiate higher prices all the time to kind of oversee or compensate for that debasement. Mm-hmm. And people often don't know what number they should shoot for. And if anything, they're often given kind of the purposeful wrong target, which is like CPI, when it really should be the debasement rate. I think one way of thinking about it is you have a certain share of all units. And if you think you're being as productive or more productive as you were last year, you generally want your same share of units. But in many cases, it's all the contracts kind of favor the other side of that ledger, and that can also give political tensions and rising populism and things like that because of that hidden debasement that we would recognize, like as you point out, on the village level, but that we kind of are somewhat immune to when we see it happening all around us.
Yeah, just for fun, I put the price of my first my first home was a 4-bedroom, 2-car garage home on a 40-foot lot just on the outskirts of Toronto. It was $268,000 and about the year 2004. The Bank of Canada on their website has this inflation calculator. So I punched it in. I'm like, okay, $268,000. What is that worth today? And it spits out, like, with their CPI numbers, that is worth $468,000 or something around that. But that house in a suburb called Mississauga, just on the west side of Toronto, is actually selling for, and don't hold me to this, I haven't checked the very latest, but it's about 1.2 million. So the Bank of Canada's inflation calculator is saying, well, it has and it even says devalue of your dollar or devaluation of the currency or whatever it says there. And the house is worth that. I'm like, well, you're not even telling us the whole truth. I can just go online right now and see the price of that home is like 1.1 million. So yeah, just on many levels, it just creates this angst. And then you have a younger population in this area that can't afford homes when an average starter home now is like $1 million or so in this area. And it creates that angst in the community. Anyway, I wanted to wrap up with this. Is there any question I should have asked you about what's going on in the world right now that you would want people to pay attention to or consider that I haven't asked yet?
That's a great question. I think this one had such a rapid fire number of questions that.
Yeah, sorry. I tried to do something new with you there, Lyn. I don't know how it worked, but we're trying.
I think it worked well. But yeah, it makes you think, like, what stone has been left unturned? Probably not that many. I would, and to your prior point, I would just tie that into an earlier statement that inflation's this weird thing because we think of it as one number, but it's really a bunch of things kind of going in different directions. So the scarcest things, like, high valued property, that tends to grow in price at the rate of money supply growth over long enough timeframes. Whereas we get way more productive at making electronics, certain types of agricultural products, and then that's weighing down the CPI calculation. And so then they're giving people this target, which is often misleading, because what people really want is they want to be able to afford scarce assets. They want to be able to afford good property, high quality healthcare, really highly nutritious food, and other kind of scarce things, and monetary goods like gold and Bitcoin. And so I think that is when you kind of run those numbers on the money supply growth, you'll probably see closer figures to that change in the house price. Yeah,
agreed. And something that Bitcoin is doing to me, and we'll wrap with this, I don't want to keep you any longer, Lyn, but what Bitcoin is doing to me is that it is really acting as a new unit of account, or like a way to measure what's going on. Because when you first get some Bitcoin, maybe you buy $100 worth or $1,000 worth, and maybe, it's not that meaningful to your life, right? And usually the day after you buy it, it goes down. So like you're like, what the heck did I do? But over time, it seems in dollar price to go up. But as you commit and grow a little more, and your savings do go up in dollar price, you really start to recognize that this uniquely scarce thing called Bitcoin is really repricing the world right now. There is not a switch that is going to happen in like 3 years where like Bitcoin wins in some capacity. It's like, no, this thing is repricing the world right now. And if you can understand it, it really has a chance to help your own standard of living increase over the next few years. You do have to do a deep dive on it. And your book is a great way to start that, Broken Money. But it, as you accumulate a little bit more, it really does change your mindset. Like, oh, there is a little bit of hope. I can stay ahead. I can save. I can outpace the debasement. And it's just an interesting time that this thing exists. Cool.
I agree.
So Lyn, thank you for this. I really appreciate it. If anyone wanted to find out what you're up to, some of your latest reports, get on your email list, where could we direct them to?
So I'm at lynalden.com. That's where they can find all my work, and they can find my socials there as well. Like you said, I have a free newsletter. I also have low-cost research service, and various public articles people can check out. Thank you.
Cool. Awesome, Lyn. Thank you for doing this. Really appreciate it. Always appreciate it. Thank you so much, Lyn.